was a wonderful conversation with Carlos there. Again, one of the pioneers in the industry. Hopefully you learned a little bit about the ecosystem that they've built. But now we're finally going to get into the meat of it, if you will. We, as a firm, Security Token Advisors, spend a lot of time not only helping our clients tokenize, but we also do a lot of education. Try to do a lot of research for folks in order to get them more comfortable and ready to actually move forward with the tokenization. So I have the great pleasure of being joined again by Peter Gaffney, our head of research and institutional at the firm. And we're going to go into a bit of a deep dive, aren't we?
Yes, we are. We're going to look at everything.
Let's do it. Well, I think the best way I think we can break this down is we have the traditional model, which is, you want to do a security token. I have an asset, I want to raise capital for it, or I want to eventually get it liquid. And you need to go through a very traditional model, but you're adding that layer of tokenization. And of course, by adding that layer, it changes everything below it. But I think we can start there to walk people through how you can go through the tokenization process. And then from there, we can go into some more use cases beyond just raising capital for tokenization. That sound good to you?
Yeah, definitely.
Well, I think we break it down most of the time with our clients in 4 specific phases. The first one, arguably the most important, is of course planning and structuring. The purpose of this we're going to get into is really making sure we've got the whole architecture, the whole blueprint down, so that when it comes to actually going into the second phase of identifying all the different vendors you're going to need to work with, it makes it much easier to have those conversations. You know exactly what you're looking for, and you'll move a lot quicker. Naturally, once you've selected those partners, you can then move forward with your actual offering to raise money. This is, referred to as distribution, right? We are distributing our product to the hands of investors. And in order to do that, you typically rely on marketing as well as some other models in the industry that many people use traditionally, as well as for tokenization. And then last but not least, what is the less common model is then, of course, going ahead and listing that once you've raised your capital. Many times there's even a period of time, a restricted period where there is no activity whatsoever. But eventually you do want to take advantage of that liquidity component to be able to take advantage of using that token in different capacities. So let's dive right into it with phase 1. Phase 1, we break down into 5 sections. The first is, again, arguably the most important, making sure you figure out the right legal structure, identifying the right lawyers to work with you on this. You can work with firms like us, Security Token Advisors, as well as take advantage of many resources that are already out there to go ahead and start getting a good idea of what that legal structure can look like. You do not need to go to law school to figure that one out. In fact, we're going to have a great session with Robin Sosno, a leading attorney in the space, just after this to go over exactly that. But that's not the same as the investor onboarding compliance. These are the different requirements and rules you're going to need in order to bring on the actual investor. KYC checks, possible accreditation, and other things. Then that's different from the actual investor subscription, right? This is where they're actually looking at the deal. They may be looking at legal documents that they're going to sign digitally. They may be looking at certain materials that you're associating to the offering for them to consider before they go ahead and actually make that investment, which is, of course, another component to it, right? Bringing in potentially payments via a bank or via crypto. Then you've got the distribution systems I mentioned earlier. You can already start thinking about now, how are you going to go ahead and actually market this and get this offering into the hands of investors? And then we've got blockchain architecture, the coup de grace of the whole thing. Of course, everybody needs to have some kind of blockchain component to a tokenization. So how do you go ahead and figure out what's the right blockchain? We also have a great panel on that later today, but we're going to try to give you a little bit of a primer. So Peter, let's talk a little bit about this legal checklist. What's the typical things you're going to see as a client, or as a client going to see going through this process?
Yeah, I think the most common, I think a lot of clients come in with a pretty solid vision of what they want. And really, sometimes they back themselves into a certain vision and then try to find one partner thinking that'll be the end all be all. And it's really just not the case in a lot of times. But looking at it from the legal side and kind of, I think a lot of them would come in and say, listen, we're an offshore company. We want to establish an entity in the US. We want to raise from US investors, or even vice versa. Maybe they are based in the US, they have deep ties internationally, and they're saying, US real estate or US fixed income or certain, different industries are attractive to other investors globally. And so they'll say, how can we actually raise capital from people in my hometown, or from people in my home country, or from, some of their family networks, whether it's a family office, an individual, a management firm, a corporation on the low end, potentially as well. So that's kind of where they would come in and really bring that initial vision, at least, kind of from what we see.
Yeah, I think that's a great way to put it. We kind of want to work back from 5 components, which is 1, the jurisdictions. Where are your investors coming from? That's going to have an impact on the legal structure. One of those very legal impacts is the filings, right? What are you going to end up needing to file based on the jurisdictions, and whether you're actually staying as a private company or going public. The investment documents themselves, they're unique to each deal. So having an understanding of what your vision is going to be very important for an attorney to identify what are the risk factors and other concerns that they need to write into the legal language of the documents that are typically a standard set of subscription documents to invest. And then the post-issuance financial services, if you already know you're going to use a marketplace, a broker dealer, collateral services, or anything else, even utility functions like we talk about in the last, all of that potentially is going to relate back to the legal structure to make sure that it is set up the right way to allow for that functionality, and very much so ease of use. Traditional raises, they tend to, for example, restrict investors from even being able to transfer or sell their shares from the investment, whereas this is the opposite. We want to pre-enable the investors to be able to transfer, unrestrict that capability, and that's just one of the many fine point situations where you're gonna run into that. So that's why we always want to make sure that our clients find the right attorneys and work with the right advisors to make sure that they prepare the right language in the legal structure, enabling it very easy from there, usually saving a lot of costs with the attorney themselves when you want to go ahead and actually prepare and move forward with all of this, right?
Right. And always important to have that bridge between private placement, typical securities offering, and the actual use of blockchain. Because at the end of the day, that's really the difference in any of the filings. It's just really, how are you using blockchain? How are things designated? How are these securities transferring? To Herwig's point, eventually, if you want language for them to transfer on an ATS, or if you're overseas on a digital securities exchange, a multilateral trading facility, whatever, that's something that usually gets baked in pretty early on as well. So again, and kind of to my comment before, a lot of issuers come in with a pretty rigid, strong vision. So, making sure all those little pieces are kind of taken care of sooner rather than later is really the name of the game here.
Yes, indeed. And that gets us on to the next step, which, not necessarily your legal counsel will be helping you with. This might come towards your technology strategy in terms of how am I going to onboard these investors? There is typically a requirement for KYC and AML. Folks, the deeper you go into finance, the more this becomes important. And the idea that you could run an AML check on your audience of investors on a daily basis to make sure that if Pete does something wrong tomorrow, I can get rid of him. I doubt that's going to happen. But you get the point. This is the idea of what a new future looks like. It's a lot safer because we're implementing this new digital onboarding. We talked a little bit about it on our compliance panel on day one, this idea of investor passporting. That's what's going on here as well. Many tools, like we just spoke with Carlos, he mentioned Securitized ID. That is one of those investor passports that, based on it being supported by other locations, you can then send over your compliance information. A big thing is, of course, being able to fool these systems. So now today, many KYC providers, they actually enable you to go via phone and check to make sure that the person looks like who they say they are and they're actually moving and it's real. It's not just a picture. And naturally, a lot of this can be embedded into the user experience. As I said earlier, this can be sometimes default in a technology provider that's including the investor onboarding component, or it can be separate. Again, based on your technology strategy, you may be building something custom, and so you need custom providers for that piece. But the point is that this piece will allow you to onboard, if you wanted to, 10,000 investors in a day from a technical perspective without any human interaction. Now, I say that because naturally it needs some really good QA and instructions on the website so that it's super easy and seamless for investors to do that. But if that is the case, there is nothing preventing you other than, potentially some, depending on the legal structure, that you could then onboard 10,000 investors, again, without having 1,000 people on phone calls. Now, of course, a human touch always helps facilitate that and optimize that chance. But the point is technology makes that possible. Peter, of course, we got through the kind of boring stuff, the legal, the compliance. We're talking now about the real user experience, the thing that matters, the investor subscription. How do we plan for this? What should clients usually look out for?
Well, the interesting piece is it really depends on the level of the client. If they're more, if they're like a lower level or, kind of lower market investment fund, then they have a bit more leeway. As obviously you get up into the more institutional side, you're going to be a bit, carriaged as to what you can really do. But really the name of the game is to reduce touch points and just to reduce that interaction. And exactly what Herwig said in the previous slide. From the actual onboarding side, at least. And so when investors are coming in, and this isn't something new, it's newer. This isn't something limited to tokenization, but rather just having all these, digital portals for investment management, for investor onboarding, for investors themselves to interact with the issuers, deal room, and documents and whatever. It's become more common now, even for investors, to have 20 different deal rooms to log into. 20 different issuers, let's say. So the real goal is to how do we aggregate all of these into just one kind of host portal, or at least into a few rather than a dozen. And easier said than done. Again, the whole theme of the last couple of days is seeing how things are becoming more interoperable, how firms are connecting to each other in more efficient and effective manners. Later we'll talk about some use cases that are showing this already. But looking at it purely from this standpoint, everything is going to be, uploaded right here into the deal room online. It's an important part also from the issuer standpoint. What I want to touch upon is the actual experience. Sometimes you, as the issuer, if I'm a real estate manager, I want to bring on 100 different investors. I want it to be branded PGAF Realty or something like that, quick example. And I want everyone to see that it's my site. They're coming in that maybe I'm white labeling technology and licensing in the back end from one of the various players we work with. But everything as the investor, you're coming straight to me, versus if you want maybe just a one-off issuance, I can work with a company like Securitize, more in the mind from the previous panel, anything like that. And investors will interact directly with that platform rather than with me in that case.
Yeah. And I think a great thing to highlight is just like with the legal, it's all about kind of working backwards from that vision. Usually a lot of the time you have an idea of, I want this hosted on my website this way, or I want to build it my way, or I'm happy to host it somewhere else where there's already credibility built into it and they already have a nice standardized system. Yeah, and it boils down to like what you said. This is the user experience. This is where I'm interacting with the deal room to see, to get convinced to be able to invest. And then I'm signing, I'm wiring or paying for my investment somehow. This can typically be and traditionally is a 6 week to several month process. And now again, digitization enables this to be sped up, to be easier, to give the user control to make the decision to invest without having to talk to anybody if they want. This is all going to be important to how you want to bring on investors. You can actually figure out what that investor subscription experience will look like. And once you have an idea of that, that naturally means you now need to figure out how are you going to get investors to that investor subscription stage. And naturally, you want to think about your in-house marketing. This is, of course, any company strategy wanting to do a financing event or talking about raising money in the old school way. It typically meant the entrepreneur or whoever is running the fundraising process to evaluate and come up with a similar deal room. But instead of it being a very public or open experience, it was a very closed experience. They think about all these different investor lists or groups that they can go after and pitch individuals. Now that's different. With tokenization, of course, we can leverage that digitization component, the fact that everything is seamless and accessible online. That means we can now tap into more scalable solutions for marketing, which is, literally coming down to potentially ad spend. If you leverage certain exemptions in the United States or across the globe, you can actually go ahead and do a radio ad, do a film ad, do a Facebook ad to help, try to reach an investor and say, hey, come check out my deal. PR and media is another, of course, big angle to that about pending filing and all that good stuff. And then there is the new evolution of those old school ways. So instead of having to go to an investment bank and them going and calling up their Rolodex, if you want to stay old school, they're now leveraging an audience of email addresses and accounts that they've onboarded and are able to digitally reach and enable them, of course, to invest through those broker solutions, which allows you to tap into a third-party distribution system. But not all third-party platforms are brokerage platforms. They're not necessarily broker-dealers. There are crowdfunding portals. There are other platforms that the way that they are structured enable you to tap into the audience there without necessarily having to enter into a broker relationship. And then last but not least, of course, as we again just heard from TokenizeThis for on-ramp, they access hundreds, maybe even thousands of RIAs in order to basically allow you to distribute to investment advisors who have their own book of clients who now through these channels can present them new tokenized opportunities to invest in. And of course, these are all very different marketing strategies, right?
And those last two pieces there, third party, these last three, brokerage, third-party platforms, RIAs, and traditional routes is really where we need to kind of hammer home. It's still, as we heard from Eitan Butler and Richard Luptig, Castle Dalmore Group and Castle Placement, respectively, there's still a lot of room to run right now on the the private placement side, raising from retail and kind of raising direct on your platform, which is great. And that's also the in-house marketing and the kind of traditional marketing avenues, more like an e-commerce branding, if you guys remember that statement. But even looking at it to unlock, bigger capital pools, I think a lot of the firms, the RIAs, it's just challenged to figure out how they can really hold it. A lot of this comes and backs up to the custodian side. So as that layer, that kind of base layer improves and gets a bit more connected, we see BNY Mellon yesterday. We see, Tried and Trust on the custodial side. We see, or fund admin rather, we see some of these players come involved. As that builds and fortifies, that's where you'll see more traditional routes, the RIAs, wealth management, capital, private banks. Already seen that with Citi. But that will unlock tremendous pools of capital, even for newer, higher level investors relative to what this industry is used to, but lower level relative to existing capital markets. And that's probably the sweet spot that I'm kind of targeting mentally. So it's all, in play. It's not off the table. It's just a matter of getting to that point of integration.
In other words, we're really talking about a merging of traditional ways of raising capital with this new tokenized world. And then eventually we'll have the whole enchilada to be able to tap into in a much easier and cost-effective way. Now, last but not least, in order to finish off this, again, what sometimes can be a very long planning and structuring phase is potentially clients understand new situations, they compromise or adjust their original vision. And surprisingly or not surprisingly, maybe most of the time, the client doesn't necessarily have a specific idea of which blockchain they want to use. In some cases they do, maybe they have an affinity or they know somebody there and they've been, decided to go forward just for that reason. But otherwise, it usually comes down to a lot of different concerns, which is the first, the level of smart contracts that are needed. For those of you who are very new to this, you need a smart contract for each function that you're looking to leverage, for these transfers, for these staking, for these compliance checks, for feeding in certain data. Every little bit of activity that interacts with the blockchain needs a smart contract to power it. Now, the more smart contracts you have, obviously, the bigger and more complex your token gets. And in many other cases, there are standardized systems, standardized smart contracts out there that you can just tap into, built into technology, or standalone if you want to kind of bring it in yourself. But at the end of the day, it doesn't really matter how it's written. It's just how do you want to use a smart contract? So that's very important. The next big question is not everything needs to go on chain. So you need to question yourself whether or not you actually want this information living on a blockchain, locked in, which could be for security purposes, for transparency and information purposes, corporate purposes, but also cost purposes. The more you're adding on to it, the more costly things are going to get. And so you really want to evaluate what needs to be versus what can still be tied into it from a third-party data source that's not on chain, for example. And of course, how you evaluate a blockchain, we're going to get into a little bit later. But when I look at them on behalf of our clients, I usually bucket it into 4 categories. I say, okay, first, let's look at it from a developer community, right? Ethereum has been around one of the longest to really even pioneer smart contracts. They arguably have the largest community of developers building applications on it, but you've got other chains like Avalanche and Stellar and Hyperledger and Polygon that we heard about as well, and Base. These are enabling new tools, new features that are attracting more developers there. And so, might we see a migration? You're almost betting on the infrastructure. They all use different programming languages. That has an impact, of course, to the developer community. Then there is the classic age-old cost and efficiency, right? How much is this going to cost me every time I want to do a transaction on the blockchain? Does this become something that is manageable and justified if we were to go through with tokenization? There's incentives out there, folks. There are grants in many cases from the different foundations to incentivize folks to go ahead and leverage that chain for whatever project. And in this case, obviously focused on tokenization. You even have VCs out there that specifically back projects that are using or leveraging a specific chain. Even developer support varies depending on chain to chain. So if you can get more resources, which includes also media and PR as incentives to work with that chain, that might, of course, have an impact on your decision. And last but not least, it's the investor community that ultimately wraps around this. You may not be saying, okay, well, there are developers there. I'm happy with that. They're fine. It's not the biggest. It's great, but I'm going to go with this community because they have a super engaged investor community, users behind it, so that when I tokenize on this chain, I know I'm going to tap into that community. They're likely want to also invest in my project because it shares the same chain. Those would be the kind of macro buckets that I would say. Anything you want to add to that?
Yeah, I would say looking at it, again, it comes back to the client goals as well. Someone who just wants to maybe roll the dice and raise capital in any way, shape, or form to add to their existing operations, say a private equity fund, private credit fund, a few $100 million. If I could get even 20 to 30 extra million, I'm cool taking that chance. The chain is less important, right? It really comes down to the capital raise strategy in that case. But for someone like we're seeing in the money market side, especially the treasury side, if you really want to eventually interact with DeFi, with automated market makers or kind of lending and staking services, protocols, whatever, the ecosystem is what you're going to want to look at. Like Ethereum, arguably, maybe inarguably, has the most robust DeFi ecosystem to date. And so ETH or its layer 2 chains, like even Polygon we saw yesterday, or even EVM compatible chains like Base, like Avalanche we talked about. That's where you start to evaluate, okay, where's the future roadmap looking? To Herwig's point, where's the investor community? And if I want to start rotating, crypto holders into my tokenized securities and tokenized assets, that's what you're also kind of looking at.
Yeah.
And so the depth and the breadth and the depth of the ecosystem is going to play a larger role than someone just coming in using it as a new capital raise source.
Oh, absolutely. I think that's really well put. Now that we've gotten through, we're again, we only have an hour today. So naturally, there's still a whole lot more behind these slides, but we are a business. So please come apply at our website, securitytokenadvisors.com, if you're looking for our help. But in the meantime, hopefully this gets you started on your own. There is definitely even more providers to the ecosystem that you may run into depending on the structure of your offering. But the idea is now that phase one is complete, it's going to be pretty easy for us to go try to find the right lawyers, understand what the compliance needs are. Do we need a transfer agent? Do we need certain technologies? Of course, picking up blockchain will be much easier, knowing how the smart contracts need to be used, how custody plays a role into all of that, your marketing mix tying into everything, the back office management of the investors and the administration is another whole wheelhouse that you could actually bucket into its own technology, often married with the deal room and investor subscriptions, but they can be standalone. And naturally, as we've been discussing, you might have brokerage partners of all kinds, marketplace partners, distribution partners, et cetera. They may come into the equation. So, that all tends to tie into each other in one form or another. So again, we put so much emphasis on planning and structuring before you start to engage with this ecosystem. And again, there's probably even way more, but as we like to tell our clients, this is a new industry. There are a lot of options. You may have certain preferences in terms of how you evaluate your partners, but I think we can usually put it down into 5 buckets when you go ahead and start doing a comparison within the industry. First is naturally the cost. This is usually a big driver for a lot of folks. Some want to maybe have a very strong legal setup, and they're happy to work with a top 100 law firm, whereas others would like the necessities on the legal side, someone who knows what they're doing, but they're more boutique and therefore offer a lower budget. The business model by many of the technology providers differs from SaaS to assets under management basis points and a variety of other fees and structures. You're obviously also going to want to evaluate their experience, their actual clients that they've worked with to understand, okay, they are working with either similar companies that you might want to be associated with or similar to what you're doing, or they at least have that track record that suggests, okay, this is somebody that I know if they've worked with them, those people have probably done the due diligence to make sure that this provider is the right company to be working with, which leads into that partnerships in the ecosystem. You saw in the conversation before this with Carlos, how I kind of drilled him about the ecosystem that he built, the capabilities. I asked him, who are your key partners that you work with? Because for institutions, it might come down to even one specific fund admin that is supported by a specific provider, and therefore everything can hum. That's just one, again, unique example. And then last but not least is the reverse of client experience is you should actually reach out to the clients that they just told you about, and you should review with them and say, how was your experience? Can you tell me about your thoughts on that company that you worked with for your tokenization efforts, so you can fact check exactly what everybody is touting? Anything you'd like to add to this, Peter?
No, just the connectivity of the ecosystem. Maybe you want a one-stop shop. Maybe you need to, or you want to piece things together based on where you see the ecosystem developing. So there's a whole, kind of debate or just two schools of thinking between kind of a closed network. You show up, boom, they'll take care of everything, run the ball down the whole field. Others is more of an open source, open ecosystem approach between, primary issuance and transfer agent functionality to secondary trading to third parties in the middle.
Yeah, no, I think that goes back to this recurring theme of, as long as you have your vision down, it'll be a lot easier, especially if you work with someone like us to help you figure out exactly who the right firms that you're going to need to work with, because you absolutely cannot do it on your own. Phase 3, of course, now that we've gotten our partners down, we know exactly what we're tokenizing and how we're doing it. It actually needs to get funded. And so, of course, we will be doing a full breakdown. Actually, we increased the length of the blockchain panel. So this will actually be at 2:30 today, but we will be diving into the exact details of distribution and marketing because, again, it is so important and deserves its own, topic. However, you should expect going into this phase, just like any other fundraising event, right, that this is going to usually take around 3 to 6 months for most projects that experience that timeline. Usually they have some kind of answer from the market within that 6-month period. But we've already seen in the case of realty, as we heard from Remy earlier yesterday or on day one, they've had properties literally sell out in minutes. We've seen that also in some other situations outside of realty. And you can also structure it so that it's open-ended. This could be a continuously growing token model, or in many cases, it is not, dependent on a specific timing period. And so you're able to, take a longer time and even sometimes take years to eventually find that capital. And so you need to really consider, are you going to do a diversified distribution strategy? Do you want to try to tap into as many different channels as possible? In other situations, some folks like to put all eggs in one basket. This can be dependent on your budget. You may be limited to only selecting one solution to be able to move forward with. And you really want to evaluate all that from a paid model of, okay, I'm going to pay up front and I'm going to hope I'm going to get a return from investors. There's performance. So you know that you're only paying for when money is actually brought in. And then, of course, you do want to consider what you can do grassroots, that organic reach that you can get from your customers, from what you can do without having to go to pay to play type options. And we need to remind everybody, of course, and if you didn't catch it on the title slide, none of this is investment or legal advice or really anything like that. But we want you to know, of course, there is no solution that magically is going to guarantee you suddenly your fundraise. It doesn't matter. A bad asset will remain a bad investment. And tokenization makes it easier for investors to access. It may even lower the risk for them. But ultimately, it's not going to change the factor whether they like the investment opportunity or not, right? Anything to share here? Well, I'm going to break it over to you again. This is such a big topic. We even have a special guest, Centrifuge, who will be bringing in their take. But this liquidity and financial services is a big angle that you need to consider, right?
Yeah, definitely. And this is the one, this was always the holy grail, I feel, of the industry, saying you can trade real estate assets the same way you trade a blue chip stock. And it's taken time to develop. And, we touched upon that. We saw some of the secondary trading activity yesterday. But really the ultimate goal is, any new liquidity is probably better than no liquidity. And even when you look at major funds on Blackstone's side, on Carlyle's side, and the redemptions that they offer, we're already seeing companies like that making use of tokenization to improve that process. So Hamilton Lane, for example, has, I think, 5 or 6 funds total tokenized right now across, I think 3 or 4 different platforms, different goals with each one. But, eventually them and companies like them will probably end up using the technology that we're seeing on the transfer side, whether it's a bulletin board system matching orders or a bulletin board system supporting certain permissioned parties. Instead of them having to boost their back office or reconciling any redemptions or swaps between parties or between themselves and investors, all that can be handled on chain. Like we said yesterday, like we've been saying today, no need to increase back office headcount when you can just rely on the blockchain ledger for all of that. So from that is one angle, and eventually even to alternative trading systems or MTFs or different types of regulated trading venues that support digital asset securities and security tokens, tokenized assets, whatever nomenclature we want to roll with, that's always expanding. But that's really where the end goal is. And offering liquidity in these types of, just different asset classes that may already have it, but are maybe lagging, like we talked about earlier with the reporting times and the lags there, or even new asset classes that typically don't change hands at all. And if you're changing hands, you might be taking a 20 to 30% haircut just to get it off your books. And so even if you have, this is a common thing, even if you have maybe a 10% trading discount on one of these less liquid marketplaces, that's still an improvement on the 20 or 30% discount you normally take in the typical OTC market.
Oh, absolutely.
And, don't take that as the quote, because obviously it varies greatly based on asset class, on the asset itself, the market sizing, your own network, which is why I still think banks and existing players have a big advantage, and they should start leveraging this technology for the reasons we've been saying. If they're already running these types of deals, making their profits there, leverage this technology. You can increase your own bottom line, pass it through to your team, to your investors, roll it out into your own R&D activities in the space. I think that's really where things should be going and where the banks should be looking.
It's a no-brainer. That's why we're seeing some of these pioneering banks already looking at it, and for sure why I think the industry is inevitably headed there. So that, folks, that's the 4 phases of doing a security token offering.
I'm sorry, real quick, just to go back to that slide. Looking at it, I kind of got off topic there, looking institutionally, but looking at it really from the existing security token ecosystem as well. We have, lenders is one option. Eventually, people want to be, I don't want to say staking. People want to be, holding or using their tokenized securities to gain, just to borrow against. I'm losing my words, just to borrow against, much like anything. And that's a simple transfer. If you have permissioned wallets or services, maybe a custodian in between that could facilitate that between Herwig and I as a major bank, and I'm an issuer. Cool. You could borrow right against your own investment. Additionally, when you're looking at managing liquidity on the secondary markets, we have seen a few different companies use tender offers or share buyback provisions. I think INX, Exodus, and Aspen Digital and their St. Regis Aspen coin, and that's actually been quite successful. We're seeing it generate liquidity, or at least stir up liquidity, and investors are actually, if you go check out the chart on St. Regis Aspen, they're getting quite a nice return over the past couple of years, especially the past year when these buybacks really started happening. So again, the whole thing of tokenization is, go public while staying private. And these companies are making use of very similar provisions as public companies listed on NASDAQ or with NYSE, making use of the similar just treasury and market management tools.
I mean, doing a traditional direct transfer for an investor would typically involve lawyers, and a lot of approvals would be a very antiquated process. Finding other buyers would be very difficult given markets are so specific. There were very little, if any, broker dealers, except for maybe large startups that actually even enable liquidity for private companies. Lending it would be complicated because you want to try to find valuation agent, or you want to even find a lender that's willing to go ahead and lend against a illiquid asset like that. And of course, it's very uncommon and it is an expense for companies to go through that process of setting up a buyback program, but not with tokenization. All of these tools, like a Swiss Army knife, become available to you just by leveraging the rails of tokenization. Now, of course, we are going to get a little deeper into that later on, but I do want to just summarize that this is the traditional way that people are raising money with their security tokens. I want to highlight, before we move on to some of these other use cases, that a lot of people look at the tokenization model and say, hey, again, this is a magical, great way to raise money. And they say, you should invest in my offering because we're tokenized. And we think that's a big no-no. We're not saying hide away from the fact that you're tokenized. We want to say highlight the fact that you're enabling features such as potentially secondary transfers, liquidity, collateralization, but by no means should anyone be investing into anything purely just because it is tokenized. I think we've seen that story and how it ends in the crypto world. So of course, people are going to care at the end of the day about what your offering is, which means you need great planning, you need a great structure, you need great partners in order to make this a seamless experience for all the investors to participate in and for you to be able to distribute your deal easily to get to the eventual holy grail. of liquidity, where we now have hundreds of tokenized products that have all gone through this process, now available on a variety of the different liquidity solutions that are out there. And as I have said yesterday, and as we're seeing each year, the number of total issuances just continues to explode, and we're going to see an insane amount of growth, I think, next year and the year after that in terms of just sheer number of issuances, because the infrastructure is here, folks. I think, Peter, and before you even joined in 2020, you might have picked up on a few calls where I was working with clients, and this process would probably be more like 6, 9, 12, 15 months to get through. And now we've had clients that probably can get through this process in 3 to 4 months if they did everything diligently. Right. So that's how the industry is progressing and advancing and making it easier to tokenize. If you're thinking about doing it before, it's now an even better time, of course, to get into it, and very an opportunistic time. But as we have learned at this conference, security tokens and doing STOs, if you will, that's just one facet of finance that is absolutely getting disrupted and transformed due to tokenization. So let's talk about some of these other use cases here.
Yeah. So we have the list up here, right, for anyone looking, but really it's, institutions are going to have to save money before they can make money. And so looking at really how do we streamline what underpins all this, when you see products, when you see investments happening, when you see capital flowing, everything has to flow back to the back and middle offices eventually in some way, shape, or form. And that's really where the lag, it kind of happens. And so the more we can reduce those touch points, but the more we can reduce the days, any settlement, any transfer issues, whatever, a lot of it just comes down to different people. And if Herwig happens to be sick on Friday, now I got to wait till Monday for my thing to reconcile or to get a certain report I'm waiting back. If he's the end guy that I'm waiting on, there's usually a fail safe. Someone else on the staff has to come in, but we know there's a delay there. If they have to get up to speed on whatever, simple issues like that. And it's kind of ridiculous that that's what's holding back so much of the capital markets industry, or not even holding back, but just slowing it down.
Yeah.
And so what we see a lot even from our clients looking at this is, okay, the more we can reduce touch points, whether that's with a DLT tech like blockchain, whether it's with one of these service providers themselves and rolling out a whole suite, the better. And eventually figuring out how to commercialize that and enable it to just have tentacles into all the other lines of business is really the holy grail on that end. And it's just the next wave of technology.
Yeah, and it's with leading to all of these new use cases. So let's touch on a few of them. I know we've gotten pretty deep into the back office here, so I think we can move on. But again,
I would say these specifics here, it's easy to say, digitize the back office, but it's really like the way we look at it is you're permissioning different parties into a shared mutual ledger. Otherwise, we have Herwig's Excel sheet. You got to email it over to me. I got to check it out. Okay, I give my stamp. Oh, I found an error. Okay, let me update that. Send it back to Herwig. Oh, he's on lunch break at Chick-fil-A, knowing this guy. And then he's coming back. I have to wait. And I'm not getting these processes. And a lot of the viewers, I'm sure, these processes and this scenario actually does happen. And it's pretty ridiculous that is how the flow is going. And just going back and forth on anything like that versus if we have one shared ledger, boom, right here on the table, I'm adding my side to things. If Herwig catches a mistake or something that needs an update, we're waiting on something, everyone around me can see, and we're all waiting on the same thing. As soon as Herwig submits, boom, we all have access to that in real time. No need to go back and forth on the Excel. It really is like a Google Sheets, except on steroids, because it's not even that you're waiting there. It's, of course, you see any changes in real time that are happening and anything pertinent. And that's how you could then bring your fund admins in, your accountants, your tax assessors, your transfer agents, the issuer themselves, any reporting agencies even, which is a pretty good value add, even like FINRA, the SEC, whatever. But that's really where you start to see these efficiencies come into play. You're reducing any shadow accounting, reporting to your own LPs. If it's end of the quarter and they're still waiting a month later saying, hey, where's my quarterly report? How'd you guys do?
Which happens plenty. And
you can say, well, I'm still waiting on my fund admin to give me the final docs. In fact, so I can't even tell you anything because I'm in the dark. And now you're reconciling to make sure the fund admin did their job right. It's just kind of a ridiculous process all in. And this is the whole goal, to streamline that, bring it more to real time. And that's it.
I think it's super important to highlight that it's not just the efficiencies from automation and technology, but it is about that data redundancy, the risks of human error, right? Like, hey, if I make a mistake on one of these spreadsheets and now suddenly that's the trail of information that everybody is using off of, that's a huge problem. Whereas at least thanks to automation and thanks to this data transparency, everybody can operate on the same information. And I believe it was, in a conversation with Pat Amaro, the CEO of Invenium, who mentioned that there's a firm that gave the stats for about the 70 finance professionals that they had. They had about 1,000 back office people to help make the people that make the money work, So absolutely crazy stats that we're, thanks to this technology, we're going to see that number on the back office drastically get reduced. But that's not the only thing that's going to happen, because as we're seeing, and as we've heard from Wisdom Tree, from Franklin Templeton, and from many others, there are now taking the advantage or taking the opportunity to take advantage of building their own channel so that they can control the experience and remove the concentration, the dependency on certain third parties that allow them to operate their business. You want to talk a little bit about that?
Yeah, definitely. So we've covered, a few of these actually the past couple of days, but looking at it, when you look at the private fund side, that's what we said before, even one of the examples, raising capital from the existing user base, existing investor base, if you will, is the bread and butter. This is where you bring all the banks in. This is where you have your go-to bank. You trust them to run the roadshow, to find good capital, and ultimately raise you the goal that you're looking for. But we're also seeing these same firms kind of complement this with, it could be a new tranche in a fund. It could be digital share classes, like what Providence Blockchain and Figure are really trying to push forward. It could be feeder funds. Securitize is always in the news with a new feeder fund with some big names, companies all over the world. Addicts we had on yesterday, similar deal with Hamilton Lane, with Partners Group, and they all have their own kind of unique value propositions. And the whole goal is, maybe my bank is only targeting the top few percent of the wealth, and that's great. And they're probably going to continue to commit capital, but why would you limit yourself if you're an investment manager that gets paid off of AUM fees and performance fees? The more money you have, the more you can work with. It's the old saying, permanent capital over constant fundraising. The more you can increase that capital base. And again, eventually, if you want to really get philosophical and theoretical in this, if things are tokenized as a GP, you have no pressure to really sell. You may have LPs to answer to, but if you can always provide them better avenues of liquidity, you're acting more as a permanent capital channel. And so these companies are already making use of it on the left side. I think it's very interesting. We're still seeing things in the primary market and the successful raises to come, but those will be headline making when they do. So definitely pay attention to that.
I love that term, permanent capital. And here you're able to build your own community, your own audience of investors digitally like that. It's a lot easier to keep them sticky and invested, if you will. Now, of course, liquidity, this is that holy grail. Private markets, because they suffer from the lack of having marketplaces and exchanges actually trading these securities. That's a natural go-to. But most people don't realize that even a lot of the public markets and a lot of just finance as a whole is actually going to get disrupted by this technology. Let's give a quick couple examples on that.
Definitely. So one thing I love, and I was talking about yesterday, the JP Morgan's Tokenize collateral network. Basically their broader base version of the repo network that was kind of their first rollout, I believe in December 2020 officially, underpinned by JPM Coin, JPMC, that Kirti kind of walked us through a couple of days back. But really that's the deposit token that underpins all of the transactions within the repo side. And they've already done over 850 billion in repo transactions so far to date. The TCN itself went live with BlackRock and Barclays the other day, I think just Wednesday when we started this conference. It's kind of the inaugural issuance on that, swapping money market funds. Just a new way for financing, for real-time financing, for improved collateral, look-throughs and transparency. Good for banks who have mandates to meet on the funding side, on the capital minimum side, right? And I think when you look at things overnight and how just hours do not line up globally, this is a tremendous value add. Similarly, you even have the regulated liability network, RLN. pretty much spearheaded by, Citi primarily, but a dozen other banks. I believe the New York Fed is also involved. Basically, the whole thesis about, superior stablecoin alternatives, CBDC alternatives, because that's definitely a debatable topic in the space. And this is something that's meant to basically be backed by a blend of like deposits, of global currencies, of CDs, of money market funds, of treasuries, other cash equivalents, to basically create a blend and use that in a bunch of different digital systems. And then lastly, even Broadridge is also playing in the repo game with their distributed ledger repo DLR. They're doing 30 billion a month in repos. SocGen, DRW, UBS as a more recent user, and SocGen, as we mentioned, is already seeing savings of $100,000 per million transactions. Don't quite know how often that million is lapsing, but as we keep saying, these are the smallest of scale that they'll probably ever be. So the fact that you're even seeing savings is tremendous, and rolling that up at scale is going to be even bigger.
Trillions it's a big number. Now, liquidity is obviously that's thanks to that instant settlement capabilities and a lot of other features from smart contracts. But we're also seeing the banks test out bond issuances, right? And loan issues. We've seen a number of big projects all around the world, not even listed on this document here is the European Investment Bank, as well as many other players. But let's talk about some of the ones that are definitely making a lot of waves. Project Guardian out of Singapore, definitely making waves.
Definitely one everyone in the industry should be familiar with by now. I mean, you're seeing JP Morgan, you're seeing HSBC, you're seeing MarketNode, you're seeing Temasek really work with in the Project Guardian initiative, and it's since kind of branched out. It encompasses so many different projects now. I remember JPM had that tokenized Singapore dollar swap, I believe, over a permission version of Ethereum as a part of Project Guardian. That was pretty cool to see collateral movement on a public chain in real time. You have different bond issuances coming out of some of the banking partners on that front. You have trade finance, which is another cool area, if you will, segment of finance that's being revolutionized, bringing letters of credit and the time down from 5 days to maybe just a couple hours. Again, similar to what we were just saying with all the touch points, you're not waiting 5 days for everyone, to say yes and to verify things. You're waiting a couple hours. It's on shared ledger. So that's all through Project Guardian. Even looking at the bonds and kind of with DeFi to an extent, Societe Generale and MakerDAO. MakerDAO is one of the original lending services in the space, if you will, and SocGen drew a $7 million loan from them back in January, posting their own tokenized bonds as collateral, as SocGen was one of the earlier issuers.
First on-chain refinancing that I've seen.
Yeah, pretty big name. And then, of course, you guys remember Anthony Morrow yesterday talking about Figure and the Provenance blockchain-based HELOCs, already 6.5 billion in HELOCs issued on chain. It's about 7% of the entire HELOC market. I'm not talking on-chain products. I'm talking the actual traditional HELOC market. I mean, when that hits 10%, how could you ignore that if you're in the space? You 150 bips of savings too, relative to traditional, enormous.
Now we do, again, there are absolutely several other use cases. We are running out of time here. We absolutely would be thrilled to go on and join us in the STA Success Network. We covered it yesterday, securitytokenadvisors.com, where we are doing this on a weekly basis from education, from research, and even being able to tap into office hours where you can talk to one of us or both of us and get into this more detail in person. But we do want to highlight some of these other services that we do beyond just advising and consulting you on your tokenization projects. As I mentioned earlier, a lot of folks aren't ready to necessarily pull trigger. They've got executive committees or bosses that they got to get approvals from. And in many times, we're able to play the role of basically putting together the right package of information, the right research in order to go ahead and help that individual get it across the line, get the approvals needed in order to continue. We are also seeing a lot of actually now bigger banks and finance firms looking to position themselves within this space as thought leaders. And so we're excited to be collaborating on some content with them to release and co-create. one of the new things that we've really been taking advantage of is over the last 5 years being in this industry, trying to talk to everybody that is doing anything supporting this technology. We've built an incredible network of vendors, right, Peter? Over 50 across lawyers, around blockchains, technology platforms, compliance, marketing, brokerage, and everything else in between. And so there's an opportunity for us where we can actually go ahead and, as we've seen, I think throughout the conference, the more the ecosystem is able to work together, collaborate, plug into each other's technology, the better and more awesome this technology becomes. And so what we're doing now is actually going ahead and working with a lot of these infrastructure firms and doing some partnership development for them to help them, again, grow their ecosystem and their presence in the industry. And last but not least, much of what we did today is we love to educate. We speak all over the world, at universities, at corporations, for family offices and investors. We provide, very small sessions, or we can do an actual workshop or put together some custom education for you, depending on maybe a specific asset or a specific industry that you're looking at for tokenization. So we do it all. There is nothing we're going to shy away from as long as it's related to tokenization, right?
Yep, absolutely.
And I would just want to highlight that, again, we've been working since 2018 in this space. We've had clients that have tokenized alternative carbon credit funds. They've developed real estate platforms. They've developed crowdfunding platforms or their own, solutions for the industry. We worked with blockchains. We worked with funds. We've worked with just about any type of asset class out there, which is one of the joys of being in this industry. And with that, please take the time to go to securitytokenadvisors.com and get to know us. And hopefully we have the opportunity to work with you on your tokenization project. And most of all, hopefully you learned something here during this session. And with that, let's head on over to, again, one of the most important topics you don't want to mess up, legal with Robin Sosno. Just give us a few minutes to get set up and we'll see you shortly.